Today's sell-off dragging rates lower, though the 30-year fixed mortgage rate is still hovering near 7%. And now home inventories are surging in certain markets as a lack of affordability curbs demand. Diana Olick here with the latest details. Diana.
Yes, Ari, the mortgage rate is right below 7%, but still bouncing up and down again. And new inventory and pricing data is showing why we're seeing a uniquely volatile market. After dropping sharply in January, the monthly payment required to purchase the average home jumped by nearly $100 by the end of February. At current income levels, it now takes just over 33% of the median income to make those payments. 24% is the 30-year average, and that's according to Black Knight. Now, that's nationally, but some of the least affordable markets are now Las Vegas, Nashville, Seattle, Miami, and Los Angeles. We actually went to an open house in Las Vegas last weekend. Just 2 sets of buyers came in 3 hours. The agent said inventory there is rising fast.
Especially here in Las Vegas, a lot of people moved from California thinking this could be where they were going to live in their no state income tax haven, and then got the call from work after COVID saying, nope, we got to come back home.
In fact, inventory in Las Vegas is now up 200% from a year ago, and prices dropped in January, but then rose into the first week of March, according to Parcel. Why? Well, those are closing, so contracts signed in January when mortgage rates hit 6%. Along with Vegas, Parcel is also seeing homes go for well below list price now in Phoenix, Tampa, and Charlotte, all of which were some of the hottest markets in the first part of the pandemic. Now, Sarah, not so much.
All right, Diana, thank you very much. Diana Olick. Let's trade that. Tim, look, mortgage rates, we thought that they had seen the top and then they climbed up again. Now with this banking trouble, they're going back down. What do you do?
They're linear and they're connected on the way up. On the way down, look, there's also credit dynamics and lending dynamics that suffer in the back of what's going on. Banks are not giving more money away now on the count of what's happened over the last couple of days. There's no question about it. So lending standards will tighten up. I think if you consider, it's great that the Fed funds, I think, went from 469 down to 428 basically in one day. That does not necessarily mean the mortgage market changed. More importantly, the affordability dynamics that Diana just talked about are the ones we're talking about. And frankly, you could see that in the XHB. So the home builders ETF today down 2.25% on a day when you saw rates plummet. We know, and it's on some level, it's nice when the market has a rational reaction to the news, that bad news was not good news for housing. And I think all that's what's going on. And again, the wealth effect across, okay, Silicon Valley is not USA, it's not Main Street, but I think some of these dynamics are slowly playing out. And I don't see why you want to own the builders, even on any weakness here.
Anybody disagree with that? Everyone's been trying to find the bottom in the builders and on rates.
Yeah, the problem, though, is, to Tim's point on affordability, who is going to be putting their house up for sale if you have a 3.5% mortgage or a 4% mortgage and you have to flip it out? You have to have owned that home for a long period of time to get some equity in it to make it worthwhile for you to turn around, buy something else for a 7% mortgage. Who's going to do that?
But doesn't that make it more attractive for a home builder, right? Because there aren't existing homes being sold. What's happening is there's millennials out there, and there's basically been 5 million more households created in the last decade than homes built. And so now people are looking to buy homes, and the existing homes aren't there anymore.
Are there enough, though? Are there enough people that are going out? Because what's really moving the market are people who are buying homes for cash now. That to me is a very, very small population that could buy a home.
Well, and some other part of just input costs, labor markets haven't really softened up in terms of those input costs. Copper prices are almost near 10 to 20-year highs. Lumber prices are down. But, you know, the inflationary and the stickiness part of the PPI cycle is, if anything, has been, you know, resurging a little bit. So there's not a whole lot of relief on the gross margin side. Again, is this a market where you want to be paying, I think, at least on a relative basis, above to where they trade to the S&P? I don't think so.
I feel like the housing trade has been all about mortgage rates for the last year and a half or so. And now today is the kind of day where you rethink the whole soft landing and what's going to happen to the economy, right? And whether the hard landing comes more into focus. Already the market was there watching the yield curve this week.
It is, and I do think that these are all valid concerns. I do think you're having this standstill in the housing market, but I continue to remain optimistic. I think a lot of these issues we've been talking about, we have been talking about over the last year, but the home builders have actually done very well. And I just think this supply-demand issue, I mean, there has been so many less houses built over the last decade because of the housing crisis that happened last time. That's just not going to get resolved, and I think the home builders are going to continue to have somewhat of a floor under where they are.